In a world of fiscal dominance, the rules are different. Economies and markets behave differently. And if you don't change your approach as an investor, it can cost you dearly. That's why I was so pleased to speak to this week's guest. Her top-down macroeconomic analysis is superb, and her comprehensive knowledge of bank lending drivers, technological developments, digital assets, and the intersection of policy and markets is second to none. Her name is Lyn Alden Schwartzer, and she is founder of Lyn Alden Investment Strategy and an analyst at ElliottWaveTrader.net. Almost 800,000 follow Lyn's work on X. More than 322,000 viewers have watched her recent presentation at Bitcoin 2025 on YouTube. And now Lyn is joining me here on the Money Show MoneyMasters Podcast. Well, Lyn, thank you so much for joining me here today. I mean, there's so much to talk about on the macro front. I know a lot of your work is kind of based on that macro overlay. But just since it's the first time I've had you on the podcast, and obviously I follow your work, but some of our viewers may not have. Why don't you talk a little bit about your background and what it is you do at this point, and then we'll kick off from there.
Sure. So thanks for having me. My initial background was actually electrical engineering, and I then went into system engineering, engineering management, but I've had a lifelong interest in investing. I've been, doing that alongside engineering for a long time, and eventually I left engineering to focus on analysis full time. I take somewhat of a novel approach of using actually kind of systems analysis in my market analysis. So basically, when I look at capital flows and things like that, I treat it like I would a system with inputs, outputs, governing logic, because these are, at the end of the day, human design systems. Obviously, it's very, very complex ones with a lot of moving pieces. And so at lynalden.com, I cover equities, commodities, other asset classes, and I'm the author of Broken Money. Came out in 2023, and it catalogs the history of kind of the intersection of technology and money.
Great. Well, I appreciate that background. My father being a mechanical engineer for many years in aerospace at Pratt Whitney, he's gonna enjoy this segment, I'm sure. Let's talk about one of the big points that you had earlier this year, and that's fiscal dominance. What does that concept mean? What does it mean for markets and the economy? And I know that was a lot of what you talked about at the beginning of the year. How have things changed or not changed now that we're talking in late August of 25?
So for the most part, they've not changed. Kind of the whole point of fiscal dominance is it tends to last for quite a while. And so basically what that means is that, unlike the past 40 plus years, where monetary dominance was in play, basically bank lending decisions and by extension, the central bank, tailoring its policy to either encourage more lending or pull back lending, that was monetary dominance. Now we're in more of a fiscal dominance environment, meaning that the size and the direction of the deficits are generally speaking a larger variable than the central bank and even kind of the broader banking system. Really, the only thing that's changed since then is obviously tariffs have heated up, recently, and so that's a slight break on the fiscal deficits because you're bringing in more revenue so far, mostly from the American public. And so that kind of offsets the deficits, but that's still fairly small in the grand scheme of things. We are still running above baseline deficits as a percentage of GDP. In addition, we have more information from the Fed, which is that it looks like they're going to be a little bit more dovish going forward. So while variables have changed, we're still largely in play in terms of fiscal dominance.
Sure, and I definitely want to talk about the Fed a little bit and what we've just learned in the past week on that front. But let's talk about a fiscally dominated market slash economy versus one where monetary policy is the main force. What does that mean for an investor? What do they sort of need to know about those two dynamics?
On one hand, it tends to run hotter, which is to say that when you're running a larger deficit, all else being equal, that's somewhat of a stimulus, with the cost often being basically debasement or inflation, at least above target what it otherwise would be. And it also tends to be less cyclical. Because a lot of those deficits are not really tied to the business cycle per se. If anything, they increase during a recession. And so while it's still possible to have recessions and you still do have cycles, they tend to be somewhat muted. It's kind of like how if you look at equities, there are obviously certain equity sectors that are a lot more cyclical than others.
Yeah.
Whereas some like defense or healthcare just tend to be on their own cycles compared to these more business cycle ones. And what happens in fiscal dominance is kind of the broader economy tends to look more like those types of industries to some extent because the deficits are kind of always on compared to the more cyclical nature of bank lending. One way to kind of put it is that over the past 70 plus years, for the majority of the time, net new annual bank loans, and you can even add corporate bonds. So net bank loans plus net new bonds issued, that was a
Okay.
larger sum than public deficits. Whereas only kind of in brief recessions do you see that the public deficit would be greater than that kind of private sector lending. Whereas now we generally see, even outside of recessions in recent years, the public deficit is larger than the sum of all new bank loans and corporate bond issuance in a typical year. And so that just, it's not to say that there's other things that aren't relevant, but they're a
Yeah.
smaller share of the pie than they used to be.
And is this something we're seeing globally, not just in the US? I mean, obviously, China's been sort of on this, we got to do more stimulus, we got to do more stimulus type approach. Some of the things the administration's been doing seem to be, getting places like Europe rethinking the deficit spending. What are your thoughts on that?
So it's more so a U.S. phenomenon than a global phenomenon, but on a country by country basis, it's certainly relevant. I think, there's a cycle that countries tend to go through. The U.S. currently is running larger deficits as a share of GDP than most European nations. It's part of the structure of the euro itself that makes that a little bit more difficult to run larger sustained deficits. But they all have kind of similar dynamics, which is older demographics, they fuel some of the deficit spending because you have that more top-heavy entitlement system. So whether it's China, whether it's Europe, whether it's the US, they all kind of are in that boat together.
Yeah.
And it just so happens that because US healthcare is very expensive and the way we've kind of structured our entitlement spending, as well as generally speaking, a bigger share on defense as well, we're running hotter than the rest of those. But things matter around the margin. So the fact that Europe's running hotter than is normal for Europe is still relevant from an investing standpoint. It's just in absolute sense, the U.S. is really kind of fiscally the most dominant.
Got it. Well, let's shift gears here a little bit. You brought up the Fed, and obviously, we had Jay Powell essentially, I mean, not guarantee, but strongly suggest the Fed's going to be cutting when September rolls around. There's certainly been plenty of political pressure on the Fed to operate and do more than that. What are your thoughts on what Powell said, what it means, and sort of what the path is forward for the rest of 25 and as we roll into 26?
Yeah, I think he took a slightly dovish take compared to what the market expected. And the market kind of pretty much priced that in as soon as he was speaking about it. And basically what we should expect is generally at least slightly lower interest rates. He made no commitment to the idea that he's going to keep doing it in his 2026, but he did heavily imply that we're at least getting one or two cuts perhaps upcoming. One of the challenges, this goes back to fiscal dominance, is their interest rate tool is mostly around trying to get banks to either lend more or lend less. Because, historically speaking, during periods where inflation's hotter, there tends to be a lot of money creation from bank lending. So, for example, in the 70s, when the baby boomers were entering their home buying years, that was kind of the peak period of US loan formation. There's a lot of loans being done and greater than average money supply growth and the inflation that they came with it. Obviously, there were other factors like the oil shortages and things like that, where that money supply growth actually does translate into much higher prices because you don't necessarily have that productivity offset. But basically, that bank lending is a really big component of it, and so most of the tools are around that. The problem is that in this whole kind of COVID and post-COVID environment, because we're in fiscal dominance, the inflation we've seen has not been from excess bank lending. Bank lending rates are pretty muted, if anything. They're kind of historically normal and on the lower side. And so the Fed trying to keep rates high to slow down bank lending is kind of working around the problem. The actual core of what fueled all this was the deficits. Back in years ago, it was the stimulus, and now it's a less extreme but more sustained, just ongoing fiscal spending, which tends to run things hot. And so the Fed kind of finds himself in a position where there's no right answer. If they cut rates, it doesn't look great because they're cutting rates into like all-time high stocks, gold, Bitcoin, low employment. It looks, it kind of looks dovish on that surface. On the other hand, the housing market is pretty much at a standstill. I think even with some cuts, it's not really going to change that.
Yeah.
And bank lending is not the issue. So I can certainly see why they'd make a case for cutting. And it's just fiscal dominance. It's more about the fiscal entity than what the central bank's going to do.
Got it. You brought up markets, so I think that's a logical pivot here. I mean, obviously, we've seen precious metals be extremely strong. We've seen Bitcoin, as you mentioned, do very well, and certainly other cryptos in that the digital asset space as well. What are your thoughts on what's primarily driving it? Is it all the I need safety, purchasing power protection? Is it a lot of the projects going on in the digital space? I mean, how much some in terms of the driving factors of those kinds of asset classes are similar versus different in your opinion?
So in the digital asset space, I think basically right now corporations are the bulk of what's driving it. So if you look at kind of where sales have come from, it's generally come from those who've held for a while and are up pretty significantly on their gains, and then they sell to rebalance or to increase their consumption level in some way. Basically, for a lot of people, 100,000 Bitcoin was kind of their magic number. Some of them have been holding since 1,000 a coin or even less. Some people have holding since 10,000, but when you kind of hit that psychologically important number, you get this ongoing kind of distributive effect. On the other hand, there's, Strategy has been purchasing, Metaplan has been purchasing, and then we've seen this kind of breakout in other like altcoin treasury companies. I think like kind of prior cycles, it probably won't end well. A lot of companies filled up with kind of tertiary altcoins.
Yeah.
Is probably not something we look back on years from now and say, yeah, that was a good thing to do. But so I think that's kind of where that rotation's happening away from kind of older whales and more toward these kind of corporate treasuries until they get satiated for this particular cycle.
Okay. And while we're on that subject, I mean, obviously we've seen Bitcoin in particular, but some of the other coins get more mainstream money coming in as a result of changing policies on the sort of advisor side, plus the rollout of all these ETFs that make it easy for people who are non-crypto people to invest. Where do you think we are in that trend? I mean, is this still early stages, mid stages? What are your thoughts on that?
I still think it's pretty early stages. I think that things can get ahead of themselves for periods of time. So, for example, when the ETFs were came out, there was kind of like a local bubble, and Bitcoin kind of ended up chopping sideways for the next 7 months because of it, as things had to kind of work itself out. And then with the election and the rapid change in perception around what the regulation environment would be, that also gave us another really big pop in Bitcoin, which took another kind of 7 months or so to absorb before we went on to new highs again. So while things can get ahead of themselves temporarily, I still think that in the zooming out sense they were still pretty early. Most companies don't have Bitcoin on their balance sheet, and I think even in the next 5 years that'll still be the case. That'll still be a niche thing. Most governments still don't have it on their balance sheet. A handful do in sovereign wealth funds and things like that. And most pensions, they might have a little slice here or there.
Yeah.
But I still think that in the grand scheme of how much capital's out there, Bitcoin as a $2 trillion asset is still pretty small in the grand scheme of things, even though it's this global money that's still smaller than some individual equities are in terms of market cap. And so I still think it's pretty early in the kind of the integration of the digital asset space and then broader traditional markets.
Got it. Okay. I do want to talk about kind of your market outlook, but before I do, obviously, given your engineering background and some of what you said recently on X, you talked about how you use AI for, in your own business, but there are certain things like summarizing novels and high priority art projects that it's still not maybe, the reality hasn't caught up to the hype. I'm just kind of curious as to your perspective, again, as a business person, as well as just sort of the fascination with that part of the market, what your thoughts are.
I think, I mean, directionally, I think we're going to go similar to full self-driving, which is some of the proponents would always say it's like 2 years away, and it's been like 10 years of that. And of course, in some areas, it can work in pretty kind of controlled areas, but in the grand scheme of things, the problem is anything in the field is way, way harder. It's always easier to automate things in controlled environments than to automate things where there's all these edge cases everywhere.
Yeah.
And so, full self-driving has kind of eluded the technical optimists. And I was kind of writing that in response to basically seeing people say, in 5 years, like, it'll displace all of our jobs and things like that. While obviously there are certain areas that it's very, it's already eating into. It's pretty ripe to do that because it kind of is those. like controlled environments
Yeah.
where it can kind of iterate, learn, and then just do things with minimal edge cases to worry about. Anytime you get into the field, so when we talk about like robotics in the field, for example, it's got basically that full self-driving problem on steroids.
Mhm.
Because even the roads themselves are somewhat of a controlled environment, and yet it's still hard. So let alone everything else that might have to be done. So while I think that AI will keep progressing. I think it's already, it's good enough that it can impact more than it already has. It just takes time to kind of integrate into business and consumer processes. I generally fade the really kind of hypey, super optimistic view, or some people view it as a negative thing, but basically
Yeah.
the technical optimist view that these things are just going to be so dramatically impactful compared to humans in 5 years, I think that's too optimistic. I think we have to have more sober outlooks on it.
Fair enough. When it comes to markets and asset classes, I mean, obviously equities have had a huge rally. We're close to or at highs, depending which index you're looking at. Gold is still sort of kicking around that 3,400 level, and Bitcoin pulling back, between 110, 115, give or take. Really speaking about those asset classes, and maybe if you want to throw the dollar out there too, what are you generally still bullish on? What are you getting more cautious on? And where do you think might be a reversal out there that we're not speaking about?
So I'm still bullish on Bitcoin. Gold, I started warning about this spring because it got kind of heated. Fortunately, that's been more of a sideways consolidation than a correction. And I think it's kind of you know burning off some of that heat, kind of like Bitcoin had to do a couple times this cycle. So I'm still long-term bullish on it, but it's still kind of working through that. I'm increasingly a little cautious on U.S. equities at these levels, given the ongoing headwinds that are still there, including tariffs and things like that. I also think that rate cuts, while helpful, are probably not going to be as stimulative as people think, because without a kind of lower low in rates, especially longer term rates, I think any sort of like home refinancing cycle is going to be pretty muted this time compared to prior cycles. And so while it helps certain entities and individuals around the margins, I don't think that we'll have any sort of big gains from that rate cutting cycle. Where I tend to be more bullish is foreign equities. I still think they're very under owned. In many cases, still fairly inexpensive. And the upcoming dovish cycle should be somewhat beneficial to them. So I tend to think there's a lot of kind of you know kind of returns to be had over the next 3 to 5 years from more of that foreign sector.
Okay. And again, everybody has sort of different policies about this. Any particular stocks, ETFs, sector ETFs that you think are more promising than others that you'd be comfortable naming, or you just want to kind of keep it at that macro level?
I would say the macro level, although I would point out that I tend to be interested in some of the financials in those areas. So I've been interested in Latin American financials, for example, basically things on the more value side of that. And these kind of when people talk about like equity rotations, it's always hard. There's been this very like a long line of people calling for rotation over the past 5, 10 years. We've had just kind of pretty miraculous outperformance of U.S. equities compared to the foreign market. I think the kind of key thing to keep in mind is that anytime there's a rate cutting cycle, that's kind of like the shields down, where if rotations are going to happen, that's a really good catalyst for it to happen. It ended up not happening during the kind of the pre-COVID rate cutting cycle because we had all these other factors coming in at once. So it's not to say that a cutting cycle does cause a rotation, but when you already have basically all this global capital on one side of the boat stuffed into U.S. markets, huge period of outperformance, and then you do get ongoing cutting cycles, that tends to be a useful catalyst. And really, since the Fed started cutting last year, at least a little bit, we have generally seen an uptick in performance of international markets. In many kind of areas, they've kind of at least stopped underperforming.
Yeah.
They haven't had some sort of major positive rotation yet, but at least there is kind of a bottoming if you look at some of these ratio charts. And I think it's useful to keep an eye to see if that sustains. I expect that it will, but I'm kind of fully aware that this has been one of the hardest things to call is any sort of change in leadership.
Okay. I guess probably the last asset class I haven't talked all that much about would be what to do in the fixed income space. I mean, do you see things in terms of credit quality that concern you? Do you know any thoughts on the yield curve and so on? If people are looking to trade those types of trends, where do you stand on that?
So for like 5 years, I've been a pretty outspoken bond bear. But now that yields are higher, I'm less kind of bearish going forward, even though I'm not particularly much of a bull either. I think that we will get shorter on the front of the curve. I think the longer end of the curve is probably in a choppy sideways pattern. So it's a tradable asset, but it's not particularly compelling from like a longer term investing standpoint. You get potentially a lot of volatility without a ton of returns from it. Um, I'm not that worried about credit quality overall. I think there's obviously some pockets that are concerning, but they tend to, it's a more slow unfolding default cycle, like for example, commercial real estate and so forth. Those tend to not be big enough to sink other parts of the economy. Unlike, for example, the subprime mortgage crisis was
Yeah.
was large enough, it hit right at the core of residential housing. I think fortunately we're not in that situation. So these more kind of smaller pockets where, you might have a multi-hundred-billion-dollar problem, which sounds like a big thing, but when you're talking in the the size of the U.S. market, with well over like 100 trillion in assets out there, those issues tend to be absorbable. So I don't focus heavily on the there are credit analysts that dive a
Yeah.
lot deeper than me, but I mainly look out for big things that could affect macro, and I tend to think that they're at the current sizes, they're probably more contained to their areas.
I guess last question is kind of an odd one because surprises by their nature are surprising. Is there anything that you think could be surprising or anything that might be we haven't talked about already that really is something an investor should be keeping their eye on here?
Yeah, it's a good question. I think a still big question, I'm not the first one to raise this, is how long is this CapEx cycle in AI going to go? Basically the GPU cycle, the data centers and all that. Because if you look at the broad economy, most pockets are kind of stagnant, not doing amazing, and anything kind of tech or AI related is kind of lifting everyone up. And so as soon as that slows, that's another potential catalyst for global capital to want to get out. Then you have that inverse wealth effect potentially. And so whenever you have a very financialized economy where rising stock prices fuel consumption, and then that consumption fuels rising stock prices, the problem is that that virtuous cycle works well up on the rising side, but then it can kind of surprise you with a vicious cycle on the other side. And while I don't think we're there yet, it is something that I do monitor pretty closely. Just because again, there's all this capital already stuffed into U.S. markets, and it doesn't take much to at least get a very kind of slight reversal.
Yeah. Well, Lyn, I want to thank you so much for taking some time out here to join the podcast. Viewers, you're watching this, you're listening to it on an audio platform, whatever the case may be. Your best chance to learn from experts like Lyn, in addition to the podcast and some of the virtual expos we have, is at our live events. We've got the upcoming 2025 Money Show Traders Expo Orlando set for October 16th to 18th. Hope you can join us there. Again, Lyn, thank you so much for your time.
Thank you.